PEG, or price earning to growth ratio, is often used along with PE ratio by investors to analyze the relative value of a stock. It is particularly useful in companies with high PE but also high growth rates in earning. In this video, let's take a look at the definition and the calculation of PEG ratio, what it means and what it really tells us. I will also use an example to demonstrate on using PEG ratio in evaluating a stock price. First of all, by definition, PEG ratio equal to price earning ratio divided by the earning growth rate, or PE over EPS growth. So why do we want to calculate this ratio? And what is the significant meaning of PEG? In previous video, we discussed the use of PE, or price to earning ratio. And let's say here, the company's share price is $100. And the company is earning $2 per share annually. That's the earning. So the PE ratio equal to 100 divided by 2 equal to 50. Well, a 50 times multiple seems a little bit expensive, isn't it? Well, if the company always earn only $2 per earning annually, it is a bit expensive. However, if we use PE ratio alone, we may miss a good part of the big picture. In this case, for example, if the company's earning is not going to be staying at $2 per year forever. In this case, let's say if the company is growing at 50% a year. In other words, even though the current earning is $2, next year it's going to be $3 at 50% growth. And then the following years will be $4.50, and then $6.75, and then over $10. As you can see, the future earnings is increasing. Wow, so how do we consider this? So if we take the PE ratio 50 divided by its earning growth rate, in this case 50%, 50 over 50 equal to 1. What it really means is that the PE ratio is only 1 time over its growth rate. All of a sudden, it makes more sense that the reason why this company is selling at a high price multiple because it's high growth rate. And this is how PEG is used along with PE ratio in evaluating stock price of typically technology-based company or other high-tech industry and sectors. In general, a higher PEG value means the share price is more expensive, even after taking into consideration of its earning growth. So the lower the PEG value, the better. It means that we're paying less for growth. Typically, PEG equal to 1 or less is highly desirable. Now, one thing we should also consider when using PEG is that, are we using a 1-year growth rate or a 3-year average or 5-year average growth rate? It all depends. It depends on your investment horizon. If you're planning on investing in a company for the next 5 years, then it makes sense to use the average growth rates of next 5 years. In the previous example, it is based on 50% annual growth in the next 5 years. And in this case, it also means that you must have a very high confidence that the company would be able to grow at 50% a year in the next 5 years. Okay, here's an example on using PE and PEG ratio in evaluating if a stock price of a given company is relatively cheap or expensive. All right, I'm going to go to this website, gurufocus.com. Well, I do not have any endorsement deal with this website, but they do have some good information for free, right, without subscription. And I'm going to use GOOG, Google. As everybody knows, this company, scrolling down to the middle of this page, you can see PE ratio of Google currently is about 17. All right, so scroll to the middle and you can see versus history. So comparing to other almost 300 companies in the similar industry, and wow, the range is between 0.36 all the way to almost 800 with a median of 17.3. So Google is right on the average. That gives you some idea of whether it's reasonable compared to other company, okay, in terms of price multiple. And then compared to its own historical range in terms of PE is between 8 to 66 with a median or average of 27. So a 17 currently is cheaper in terms of price, okay, cheaper than its own historical average in the past 10 years. And then if we look at the forward PE is at about 15.9. So compared to other company in its similar industry is between 3 to 1500 with an average of 1601. So it's quite reasonable. Again, it's almost right on the average, okay. And go further down to PEG ratio, currently is 0.65. So again, compared to others in the industry, so the range is between 0.04 to 68 with a median or average of 1.05. So at 0.65, yeah, is cheaper than the average, okay. And compared to its own historical range is 0.36 to 31 with a median of 1.45. So currently again is 0.65 is quite cheap, or relatively reasonable, but not so fast. Let's take a look at why is Google is cheaper than its own average and others. Well, let's take a look at the 3 years growth rates in terms of revenue, EBITDA and EPS is quite high, from 25 to 36. Now that's the past 3 years, and then go further down, the future 3 to 5 years EPS and also revenue is coming down to 13 or 11. So that means the market is expecting Google is growing slower in the next 3 to 5 years in terms of its revenue and in terms of its earning, and that means the growth is slower, so the market is they're not willing to pay a higher multiple. That's why the PE and PEG ratio is coming down. So remember, this is not a way to evaluate its value, but it's just relatively whether the price is reasonable compared to others in the same industry or its own range, whether we see it's relatively cheaper than in the past, than the average, etc., but not the absolute value, okay. So for whether it's reasonable, cheap or expensive, compared to its intrinsic value, that's for another video. When doing your research on investing, I would suggest to use multiple reporting sources just for comparison purpose, and also just to make sure that one website their data or calculation is reasonable enough. And also I tend to use the more conservative one just to be safe. All right, so here again, let's take a look at Google on, let's say, yahoofinance.com, and here Google, and its current PE ratio is 16.84. That's similar to the 17 on the other website. And if we click on the analysis tab, and that will give you the different earning analysis, and currently there are about 32 to 34 analysts working on Google, estimating forecasting everything from earning, revenue, its history, the trend, and and finally at the bottom is the growth estimate. And we can take a look at, okay, so the next year they are forecasting the growth rate is at about 12.3, with the next 5 years roughly at about 9, compared to the past 5 years 28.5. As you can see that these analysts are also expecting Google's growth rate is coming down, is slowing down, and which is quite reasonable given the fact that our economy is slowing down and we're heading into a possible recession. I hope this helps in understanding and using PE and PEG ratio in your valuation of a company's share price. And please remember, PE and PEG should not be used alone, but to complement other valuation methodology. If this video is helpful to you, please like and subscribe. And don't forget to click the notification bell so you won't miss other video. Until next time, take care.